Good evening, everybody. Today is indeed a sad day for all of us AIMers because just an hour back we came to know about the sad demise of our Professor Ed Morato, whom we call affectionately Edmo. And we were fortunate to have him in our webinar last year in May 2020. And it was really one of the highest audience, around 300 plus had come in. So I just would like everybody to pay a moment's silence before we start with the webinar.
They call me the Mac because I'm a teacher.
Thank you. Good evening, everyone. Today is the 48th edition of the AIM AI Fame webinar. And today we have with us Mr. Vivek Chandy, batch of 2002, Executive Director in DBS Bank. And he will talk about how digitalization has impacted the corporate banking sector. Without further ado, Vivek Chandy, all yours.
Thank you, Nikhil, and good morning or good afternoon to everyone, wherever you are. I'm just going to share my screen, and I'm going to be walking you through a presentation on the impact of digital banking. The impact of digital on traditional corporate banking. Is everyone able to see my screen? Nikhil, is the screen visible? Okay, I take it that everyone can see what's on the screen. So I think I'll first start by talking about traditional banking. And traditional banking has historically been a very a sort of a protected industry. You can see that banking has typically had a limited risk to substitution. The alternatives to banking services, not only have they been limited, but typically they end up being usurious if one goes outside of the banking channels for credit. Barriers to entry tend to be high, and that's demonstrated in terms of how regulatory approvals, regulatory oversight, capital requirements. And then from a real estate perspective, especially for branch banking, there's always been a high capex cost associated with branch banking. In fact, even for ATMs, etc., which I would term as a sort of a real estate in banking, capex costs tend to be quite high around these. And the consequences of this being such a protected industry in the past is that there's been a high level of financial exclusion, especially in poorer countries. In terms of either unbanked or underbanked people. So I think this as an industry, this is an industry which probably has been ripe for disruption for a few years now. And the onset of digital banking has really made us as a banking community have to sit up and take a relook at how we do things. So I'm going to start by first, moving into looking at the journey on retail banking. And you might ask the question, why retail banking when this is supposed to be about corporate banking? So historically, digital banking and the fintechs have actually sort of first attacked the retail banking space. And it tends to be that we look to find solutions in high touch areas first. So if you look at fintechs, they've kind of started eating into wallet shares, into remittances, into payment processes. And even on the insurance side, we've seen we've seen on the customer front, we've seen a fair number of fintechs coming in. Good examples of these would be guys like Grab, coming in and being able to do remittances. Even the mobile services companies have also started moving into the space. But you can see Grab, Uber, these kind of guys are making a big difference. In India, Paytm would be a good example of someone coming in and starting to take over some of the payments and remittances kind of business away from banks. So as the fintechs have started eating into retail banking, what's happened in terms of corporate banking is that the big techs are now coming and competing with corporate banks. And that's something which I think corporate banks perhaps did not anticipate and have recently started sitting up and taking notice. So this is an example of Alibaba. And Alibaba has a company called Ant Financial, which owns Alipay, which is their payments platform. And if you look at Alipay today, Alipay is, it was launched in 2004. In 2018, it had about 180 million users. It does everything from digital payments to giving credit to even doing asset management. So they have a product called Yubao, which means hidden treasures, and Yubao helps people to invest money, and they have an AUM today of about 170 billion US dollars. Not bad for something which was just launched 2 years ago. It's now one of the largest asset managers in China. So similarly, just like Alibaba and Ant Financial are able to attack traditional banking, you can also see that another good example would be Amazon. And Amazon has sort of got a strategy which talks about unbundling banking. And today from Amazon, you can probably get loans. Amazon it's got about 30 odd million customers, or maybe more than that, about 35 million customers in about 170 countries. But in 2017, after they launched Amazon Lending, they had an asset book of about $3 billion in terms of loans out to SMEs. And they're able to provide these loans to about 20,000 SMEs. And both Alibaba and Amazon basically own an entire ecosystem where they can look at data and provide financial services using the data which they see on the platform. So for Alibaba, what they do is they look at all the transactions happening with a small business which is registered on their platform. They look at inflows, outflows. They look at the number of orders. They look at the number of complaints by customers, the fulfillment of orders. And on that basis, they can then form a data-driven approach in terms of identifying who are the customers whom they can lend money to. And then they kind of come in to disintermediate the banking industry, because what they tend to do is if an SME in today's market is typically borrowing, let's say, at 14-15%, and I'm using 14-15% because that's typically what an SME business owner would do. They'd use their credit card to make purchases. And we're talking about loan sizes here of 10 to 20,000 US dollars kind of loans. So these kind of SMEs, when they're borrowing using their credit card, the credit card sort of interest rate is anything between 15 to 20% per annum. So this is where an Alibaba or an Amazon can come in and say, well, we have enough data to actually know that this is the flows of from a cash flow perspective for the business, and therefore offer something like 10 to 12% kind of interest rates, which is a huge saving for these kind of SMEs. So as banks have to face this kind of a challenge, we kind of see that the future of banking is possibly going to be about who owns the ecosystem. And ultimately, owning the ecosystem is what would eventually drive how banks can sort of compete here with these kind of big techs who are coming into our space. One of the other things which happened in the last 12 months has been COVID-19. And COVID-19 has really pushed banks to accelerate digital strategies. When we were all shut down and had to work from home, suddenly everything had to change. We had to make presentations sitting at home, accessing data entirely from home, dealing with customer onboarding, dealing with credit decisioning. Everything had to happen straight from home. But the consequence of this is, while internally access to digital systems has really been accelerated, there have been other pressures on the P&L of any bank, any traditional bank. COVID has led to probably lower GDP growth rates. The responses from central banks have been to lower interest rates. As a consequence of these two things, there's likely to be a need for new revenue streams for banks, especially when banks are being attacked also by the big techs. So there's revenue pressure, which leads to profitability pressure, because NII for us is under pressure. And there's also the potential that there'll be increase in NPAs, especially in the short run, as government support starts being pulled back. Government support, especially for the SME businesses and the mid caps. And then, of course, as I mentioned, the digitalization pressure, because there's market share under attack by alternatives, whether it's fintechs or big tech. And we need to, at the same time, while we're being attacked and under all this pressure, banks need to then think about digital journeys in order to keep their customers happy. So these are customer journeys as well as employee journeys to make ourselves more efficient. So really today, it's about banks being under pressure from big techs and looking for new revenue streams and finding ways in which to use technology to drive down costs. So this is an example of which I saw on a McKinsey report about a study which was done looking at the different product and customer focus from a sample of about 350 fintechs. And you can see out here that it's split into retail, commercial, and large corporates. And what are the different types of product capabilities which fintechs are looking at? And quite clearly, the largest and easiest place to attack has been payments, whether it was retail, whether it was commercial, or even large corporates. That's the easiest place where fintechs and big tech have focused. But increasingly, we're seeing product capabilities around lending, product capabilities around financial asset management and account management coming in, and increasingly moving, while there's been a larger take of market share by fintechs in retail, it's now slowly moving into commercial and corporate banking. And this is this trend we're seeing increasing all the time. So how are banks taking an approach to digitalization? So this is again a survey which was done by a company called CV Insights, and some of this data is available on statista.com. But one can see that on the right-hand side, this is a bunch of American banks which are, and their response to how digitalization is affecting them. So what they've done is, this is kind of fintech startup financing done by banks, either investments or taking a stake in these different in fintechs in these different technologies. So that's been the primary approach which many of the Western banks have taken. The other way which they're sort of looking at digitalization is that about 43% of the banks which responded to this survey kind of showed that they were looking at incubation or acceleration programs internally, or supporting external partners. And then in about 20% of them were looking at investing in via internal venture capital funds. And then the remaining, there was about 20% looking at partnering, another 10% looking at acquisitions. And the last bucket there is about 7% looking at launching their own fintechs. But this is this trend of sort of moving towards digitalization has and taking on the big techs is going to be the major feature which we're going to see in banking as we move forward. So the areas where banks will need to sort of develop their capabilities is clearly going to be focused around how we sort of provide better customer journeys and how we provide better employee journeys. And there are three or four areas where probably corporate banking would look to improve over the next 12 to 18 months. And we can see that there are many sort of different approaches which banks are taking, but clearly this is where the future is going to be from a banking perspective. So I won't spend too much time talking about payments because that seems to be that's kind of the low-hanging fruit which every fintech attacks. I'm going to spend a little bit of time talking through KYC onboarding, trade transactions, and SME transactions. And then from a and you'll notice that these are all the high touch point areas which we deal with when we deal with customers. And from the high touch point areas which could benefit from this, it's about I'll talk through a little bit about credit and risk analytics. So from a KYC and onboarding perspective, it's quite clear that we're going to see a fair amount of, from a customer journey, we're going to see a fair amount of change happening. People are already sort of experimenting with video KYC, looking at biometrics and face matching, connecting the bank's systems to credit bureaus or government systems like the national identity numbers databases, trying to create APIs which fetch real-time data from these databases. Looking at digital signatures and verification via digital signature as opposed to wet ink. Looking at data extraction from using optical character recognition so that it's a one-time submission of documents, use the optical character recognition in order to understand which are the key KYC fields and then use those in order to populate forms. So, heavy investment into technology, heavy investment also into reimagining the journey of how you do KYC and onboarding in order to minimize the customer pain points. It's quite interesting and reflective that as we move to a more tech-savvy world, and the newer generation of people who come out are more and more tech-savvy. A survey done in the United States showed that about 56% of people below 35 actually prefer not to even enter a branch. They prefer to do everything online or remotely through a video call, and don't want to have the hassle of having to go into a branch, meet somebody, explain things. The time taken in big cities, sometimes it's also about parking, traffic, all these things. So all that those inefficiencies can be taken out by investing into a process which makes it a lot easier for the customer. Similarly, for trade transactions, I'm sure a lot of people have heard about blockchain and distributed ledger. That's going to be clearly the future. Today, we have a lot of waste happening in terms of time wastage in trade transactions. A study done by The Economist in 2018 estimated that an average trade transaction takes about 34 days globally. And out of those 34 days, about 10 days are just spent between different people waiting for documentation to come to them. And when you think about a trade transaction can involve basically the exporter, the importer, the exporter's bank, the importer's bank, the correspondent bank, the insurer, the shipper, the courier for the documents, the customs guys sitting in the exporting country and the importing country. The list is endless. And each of them asks for a certain set of data. And as you look through all the data and the interaction across all these people, there's a lot of wastage in terms of the way this is done. It's a manual process. There's a lot of reading of documents. There's a maker and a checker process in terms of entering documents or data from documents into the systems. So all of this could be eliminated and made much more efficient by using blockchain. So blockchain is effectively for a series of data stored in blocks, and then those blocks get kind of chained together. And the data in the first block connects with the data in the second block, and there's authentication signals sent between these, which help in ensuring that we kind of eliminate fraud risk as much as possible here, because if you change the data in a particular block, it affects every single preceding block all the way back to the first block. So with a distributed ledger system coming in and everybody being able to openly see the data and see the transparency which comes in, we're going to see that trade transactions over time are going to become far more efficient. And as we remove fraud risk, as we remove those kind of costs from banking, I think that will be a big benefit in terms of how we can reduce some of the profitability pressure on banks. The next area which I think is going to be significantly impacted is going to be SME transactions. And this goes back to kind of owning the ecosystem. So banks need to think more about how we can have an ecosystem or a marketplace where banks can then connect the customers with all their service providers. And at the end of the day, provide the function which banks have historically provided. If we think about banking right from the time when banking services started, at the end of the day, the reason why people come to banks is essentially for a couple of reasons. One, it's trust. Because your banking partner is the partner whom you trust with your money. And your money is essentially kept there from a perspective of a store of value, or in order to make payments or move your money, right? And then the third thing which banks tend to do is give you access to capital, which is through credit lending and potentially other advisory services. But at the root of all of this is essentially trust. So the bank is always the party whom people have trusted in order to manage money. But post 2007-8, the financial crisis, there's been a change in mindset across the world, where people have questioned whether is it important for us to have so much of trust in banks when banks caused the crisis and many banks went bust and had to be bailed out. So that change in 2008 and 9 has kind of led, I would say, to a lot of the fintechs and the big techs coming in. And today, if you look at, let's say, for example, if you're an Apple user, Apple Pay is already embedded on your phone. And so do you want to then install, let's say, a bank's app onto your phone on top of that? Because that's now a new point of friction which comes in terms of your engagement with your financial service provider. So if you could do everything with Apple, would you want to then bring the bank in and put their app on? And the answer is probably that you would still want that app there, because, as I said, people, a significant portion of people, about 2/3 of the of people surveyed by McKinsey back in 2018, still indicated that their primary trust is in a bank in order to look after their money. But on the flip side, as many as 35% are willing to try something different. And so coming to SME transactions, as I said, SMEs have traditionally suffered from being either unbanked or underbanked. And because they've been unbanked or underbanked, they have struggled to get commercially competitive rates in order to finance their business and their business growth. And so as banks try to look to build an ecosystem and try to connect customers together, creating maybe marketplaces, this is where SME transactions will start getting driven by banks, because banks will now start getting the data, looking at the data just the way an Alibaba or an Amazon is able to, and therefore be able to do faster transaction processing, faster sort of credit programs, which are AI driven and therefore machine led in terms of making a credit decision. And I think that that's going to see a big change there in terms of SME transactions. And then I go to the last point, which is on the non-high touch points, that areas that could benefit, and that is credit and risk analytics. And again, this boils down to how banks use data. So banks have a lot of data, but historically banks have always worked with systems which are in silos. And Today, because each of these systems are in silos, they don't tend to talk to each other. This is the struggle which banks have in terms of using the data they have inside with them in order to come up with better sort of risk analytics or credit analytics. As the world moves towards cloud-based computing and using APIs, the core banking systems are probably going to disappear over time. And the data lying in the core banking systems will tend to move up and move on to the cloud. And the minute that access is there on the cloud, and you can build any system to call data from the cloud, and systems can start talking together. That's when the power of using the data to drive credit analytics will improve. So to give a simple example, I could be looking at the oil and gas sector, for example. And because I have data about not just the upstream exploration space, but I also have data about refineries, let's say in China and India. And then from the refineries, we look at the off-takers and we say, oh, there are off-takers which are prime, and the biggest off-takers of oil, of refined product tend to be transportation and power generation. So it's aviation, shipping, and gasoline or diesel for cars. They're the biggest off-takers of refined products in India and China. Then the next one is energy, which is power. So, in a situation like, COVID was a one-off, a pandemic, or one situation. But if you were to be able to use data to connect all of this together, and you look at the outlook for, let's say, aviation, and we're able to have a view that aviation is going to be slow down, and therefore demand from the aviation sector is going to affect refining, and therefore it goes all the way back to the exploration and price and demand and supply for the exploration companies. That kind of data and utilizing that data can start help shaping credit portfolios, can start help shaping covenant, what kind of covenants one wants to set. And so banks are starting to look at that, but as I said, the data and data talking to each other is right now the biggest constraint. But I think over time, as we move to a more cloud, as we move more and more data onto the cloud, this is where I see a huge opportunity in terms of how banks can reduce credit cost and shape their portfolios better and respond more quickly to potential changes in end market use and how that affects the entire portfolio. So with that, actually, this was the end of my presentation and my slides, where I was talking through these various things, which are opportunities in digitalization for corporate banking. I'm happy to sort of take any questions or share any insights if on this.
Yeah, thanks, Vivek. Can you just stop sharing the screen?
Sure.
Thanks, Vivek. Because of unfortunate hacker, we had to hacking scene. We had to enable the waiting room. So now we have Rami Baba. Who is this? Is it who's this? Only those who will switch on their videos will be allowed to ask a question. So yes, unmute yourself. Yes, go ahead, Ramesh.
Hi, Nikhil. Thanks so much. I feel very lucky being the first guy to ask a question to Vivek. I just got in touch with him on LinkedIn, and I'm so glad he accepted my invitation. It's really great to hear from Vivek, and the topic also intrigues me very much. I sort of left Singapore after spending about 12 to 14 years there. Unfortunately, some of my funds are trapped there only in my savings account at DBS Bank. Now, my question is actually somewhat about, the US 1.6 trillion, spending that's planned by the Biden administration. And knowing Singapore, it's very, very sort of connected. I mean, it's very intertwined with the US economy. And I'm just wondering if, so much, stimulus is being planned in the US. Will there be a whole lot of hot money entering Singapore, and therefore asset prices rise, and that whole cycle start playing out again?
Okay, so this is not really a question about digital banking. You're more asking me a question about economics. Okay, I'll share my personal view on this. Anytime anybody spends a lot of money, there's short-term gain and there's going to be a long-term pain at some point. So asset prices may rise, but they're being inflated just because somebody's spending money, and that spending of money is not real money. We're just using a printing press to print money. So the value of money will go down over time. And that's the long-term pain that all of us will take. Historically, if you've seen, every time a printing press has been used, it's always led to some situation where either there's going to be hyperinflation or very high inflation down the line. So yes, you're going to see a run up in a lot of asset prices. That's my personal view in the short run. How long that can last, anybody's guess. I guess it's as long as people keep printing money, and then at some point the world will realize that, you know, the fiat money system it needs to be questioned. So then if I bring that back to this topic of digital, we then start thinking about cryptocurrencies. Now today, cryptocurrencies have a bad name because everybody thinks about cryptocurrencies as a way of money laundering. So it could be that if there is there is an exchange which has a regulator which is well recognized and allows cryptocurrencies to be traded on that exchange, backed by financial institutions of a good reputation and standing, then yes, that could be all this extra money being pumped into the economy. I think we'll end up seeing a lot of people looking at digital assets like cryptocurrencies as an alternative.
Pramurto?
Hi, Vivek. I'm Pramurto I graduated my MBA in 2011, and since then I've been working with a number of lenders, both MNCs as well as Indian lenders, and especially the asset as well as onboarding space, specifically in digitalization and digital processes. Now, in India, we see that there is a challenge in terms of both scale, because the number of applicants for both loans as well as people who are going for bank accounts is obviously large. So the onboarding process needs to be faster and has to be has to cater to a lot more complexity. Similarly, for for the underwriting process around credit and credit analytics, there is a question of both scale as well as the question of a digital divide, because a lot of the data, especially for SMEs in India, is still very much paper based. It's not always very digital. So in this context, how do you see DBS or other large banks helping SMEs specifically bridge this technology gap? And what plans do you have in the future, not just for onboarding, which is a pretty much known process by now, but in terms of actual underwriting and credit analytics specific for data complex underwriting such as SMEs?
Okay, so thanks for the question. So just to be clear, I am not representing DBS as I speak today. So so when you ask me what's our plan, to be honest, I'm not aware of what DBS India's plans are. So I can't answer that kind of a question for you. But generally speaking, I think what you're seeing in India as well is that there's going to be look, the Modi government has tried its best to do financial inclusion by trying to make sure that everybody can open an account, right? So there was that whole drive of account opening which happened in India in the first term of the Modi government. Unfortunately, for most people, right, whether even if you open an account, there's never going to be a lot of money sitting inside there, right? And that's the reality for poor countries. That's the reality for a country like India. So I don't know if I don't know if digital is going to be the easy solution in poorer countries, but definitely everybody has access to a mobile phone, or not everybody, but a vast majority of people, even in poor countries, have access to a mobile phone today. And not just a mobile phone like those bricks we used to have from Nokia back in 2005 and 6. even people, even a vegetable vendor will have a cheaper version of a smartphone. And the minute you have access to a smartphone, right, and as data gets cheaper and cheaper from a mobile data perspective, there is going to be more and more financial inclusion. So then the question for banks is, how do we help in terms of making onboarding an easy process using this, right? That's really the key. Now, historically, banks have always been iterative in the way we think, right? If you think about a bank account, right, back in the day when you first started a bank account, people would create these cards, something around this, on a sheet of paper around this size. They would write your name, they would write your number, telephone number. They would kind of, have all your details in branch A in Mumbai, right? If you went and opened an account with the same bank in branch B in Mumbai, they'll have to create another card and create, and write your name, etc. There was no such thing as a bank account in like before World War II. Bank accounts started coming in once there was an IBM mainframe which came in, and then it was actually a computing requirement that the machine had to be able to differentiate person A from person B. That's how bank accounts came in. So again, it's kind of iterative, that because a machine needed it, so we had bank accounts. Then fast forward to 1980s and 90s. And so suddenly we said, okay, we have ATMs. And so while earlier we were mailing your statement to you, now we kind of send your statement to you on the ATM. You can just look at what your last 10 transactions, etc. Right? Fast forward to 2000, there's an internet. So now instead of mailing you, you just look at it on your screen. Now we've kind of made that bank statement this small and said you can see it here. So it's just been an iterative process. Actually, what we need to do now is we need to rethink how do we onboard people. And that's why I said that, the way onboarding will happen is you got to have a journey on a phone, and you got to have a journey where, people, when they're clicking in stuff on the phone, the bank system can connect to a credit bureau or connect back to an Aadhaar system in India. Now, I know banks are able to connect to the Aadhaar system, and I know that they are able to pull certain data from there. So that could be the starting point, but I think that's how you're going to see that this is going to become an easier process in India. To your other question, which is about how do we then do credit underwriting? Again, credit underwriting is always dependent on what data you have, right? It's when you form a credit model, when you form a view on someone's credit worthiness, it is always about, am I going to get my money back? And if I'm going to get my money back, what is the cash flow of this person, right? And therefore, if you have to understand your customer. Now, that kind of credit underwriting and the data you need for that, it can only happen if banks, as I said, start owning an ecosystem. And that's why a guy like Alibaba, or maybe in India, Flipkart might be the next guy to do this. As they look and see, transactions happening on, registered businesses on their platform are transacting, and they're seeing the inflow and the outflow. It's quite easy for them to form a credit opinion and do a credit lending or a credit underwriting model. So this is where I think banks really need to kind of think about partnering with platforms in order to be able to be that intermediary, which has always been the case, where banks are intermediaries to move money. And that's how I see this kind of improving in India.
Thanks. Abhijit, unmute yourself.
Hi. So this is Abhijit from MBA 2012, and I've been working with banks like ICICI, IndusInd, etc. In the last 8 years. So my question is more related to digital banking for large corporates. So typically 1 million USD and above loans. Do you think there is a market for such loans to be arranged on a platform? So something like startups like Vivriti Capital, Northern Arc, etc. have been doing this and have fairly been able to get some success. But the problem is not many banks are there on the platform, and in around 3 or odd years of their existence, they have been only able to clock around 50,000 CR, etc. So what do you see the future for these platforms?
So in our experience so far, and specifically in my experience, I have actually not seen the large corporates, going onto a platform to lend. You go talk to a treasurer or a CFO in a large corporate, he's really not interested in going onto a platform and saying, oh, there are these 20 different banks. How do I, how do I find the cheapest loan? Right now, if you look at large corporates, they'll all have an empaneled set of banks. And when they have an empaneled set of banks, it's a lot more about relationships. So I don't see platforms coming in and sort of disintermediating large corporate relationships at this point in terms of large credit loans. Okay, I see maybe some of the trade stuff getting digitized, but I don't see this, platforms coming in and affecting large corporates at this point. It may happen down the line as the next generation of leaders step in and become, so the current generation of treasurers and CFOs, as they retire and move on, and the next generation comes in, that's when you might see something happening. But at this point, I really don't see that happening. Large corporate business is a very relationship-led business.
Mukesh, kindly unmute yourself, please.
Hi, Vivek. Thanks a lot for a very wonderful and clear presentation. My question specifically is related to secondary market syndication transactions, again, related to large corporates. So in my experience, I've seen that, the market information for secondary deals, primary deals is not very efficiently available. For example, I worked in the Middle East, and HSBC, BNP, SocGen, they all have their Middle East desks. But I've traveled out to other countries and I've found that these banks have a lot more deals than their, the sellers' information flows to them. So is there any way these deals can be efficiently managed and disseminated across the world, for all to benefit?
That's an interesting question. I've actually never had thought about that. I think if you want to look at something which is going to be marketed across the world, then you're talking about a name which is recognized across the world, right? The reason why you tend to have a syndication market which is quite focused on the region it is in is because the name which you're, so first of all, not everyone can do a syndication deal, right? It has to be a name which is recognized in the market where the syndication, the syndication team of a given bank has to be able to say that, yes, there's market appetite for this name, right? Secondly, when you start looking at where people want to place money, I mean, this is a question of risk and reward. So if I were to, let's say, put money into, for argument's sake, Myanmar today, I mean, okay, Myanmar may not be a great example. Let's say Bangladesh, right? So Bangladesh is, if I'm not mistaken, a B+ or a BB- country, right? So my risk reward ratio is very different. How many banks want to actually go and put money into a Bangladesh? It would probably exclude 50% of the banks in Asia will say, I don't have risk appetite for that country. Right. So to answer your question, is there a way in which you can efficiently syndicate something globally? I don't think that's going to be possible because, as I said, it's a question of a name being known globally in order to be able to do that. Secondly, for the known names, for your Apples and your Microsofts of this world, yes, probably any bank in the world would say, I'm interested in getting into a syndication of this kind of a name. Is there an efficient, those kind of names, there is no need for an efficiency because they are so transparent. You have a 10K, a 10Q, which is filed every quarter, a 10K filed once a year. There's, the amount of information you get out of a 10K document today, I was reading this somewhere, is equal to 1 year's information from newspapers in 1924. So that's the amount of information available in a well-known global name. So I really don't see this as an area which needs to get sort of digitized and disintermediated at this point.
Anybody has a question? Unfortunately, because of the unsavory thing which took place, we had to start all over again. So definitely, otherwise the packs would have gone higher. But thanks for Vivek and everybody. For now, Professor Rao, I'm unmuting you. You would like to say something, right? Please go ahead.
Yeah, Vivek, that was such a wonderful talk. Actually, Satish and myself, we both listened to it. But for me, it was like an humbling experience. It just told me that there is so much I don't understand. But congratulations. That is, you make us all very proud.
Thank you, Professor Rao. It's good to see you. I think 15, 16 years since I've last seen you.
Yes, I'm in Shanghai right now.
Oh, wow. Okay. What made
I've
you
been
move to
here for the
Shanghai?
last 5-6 years.
Okay. I don't know if you remember Rahul Coelho from my batch. He's also in Shanghai.
Yeah, I know. He contacted me. He's in AIIB.
Yes.
But actually, I haven't seen him. Papi, Dekesha? Papi? No, Satish has also been listening to you. It's very nice. And we would love to see the recording in the YouTube.
Yeah,
Thank you, Professor.
Yeah, we have Koratek Jimenez,
Yes.
past Philippine chair, and she was the general manager of the Metro Manila Development Authority during Aquino's time. And Koratek, please go ahead.
Okay, thank you very much. It's a privilege to be the only one who is a foreigner here. These are all Indians. Okay, Vivek, we graduated in the same year. I'm an MDM graduate, development, so in 2002. Okay, my only concern about digitalization is actually for the senior citizens like me, it's still unacceptable to us, and we're having really difficulty just even using the GCash is something that we are not so secure about. I'm a very traditional person, because there are two banks just right in the ground floor where I live. So I don't find it very practical for me. But I am more thinking, Professor Rao, about the unbankables, about people who do not even have that opportunity to learn digitalization. So how will we manage to teach them, even just to put up some money in the bank, because they don't have enough documents to be able to open. I know some commercial banks here, they don't require anymore, but with so much security that has to be put in place. So how do we manage with a greater population here in the Philippines, especially? They're having difficulty.
Yeah, I think so. Just on your first point about people being more traditional and not wanting to change, I think COVID showed us that everybody is willing to change. When we're all shut down and left at home, and the only way we can transact is really through the internet or your phone, and we were forced to do that, then we all did it. So we had a statistic which was given out by the banking association here in Singapore, which showed that there was something like a 70% increase in utilization of digital apps by the I think it was over 55s. Okay, and the second question which came out from that was that many of them were asked, do you want to go back to the branch once the shutdown is done? And an overwhelming majority of them actually said they were quite happy now just to use the digital channel.
I see. Okay, using your debit card, when payment. That one I enjoy very much. But going through other means of using the bank, I'm still, I still prefer writing out a check or something like that. So, but anyway, that's so probably the senior citizen.
Checks are very expensive for us in banking.
Now,
so ideally, banks would like to do away with checks over time. It just becomes more efficient if we do it digitally. To your second question, which was around the unbankables and how do you start getting them to use their bank accounts more, I think this again boils down to the fact that as the ecosystem is being created and more people are being put to made to use sort of digital payment channels, that's when people will start using their bank account more. So like I said, a vegetable vendor, probably never been to a bank in his life, is totally unbankable. But because he has a smartphone, he can actually go onto his phone and start and go and open an account. Okay. Right. And if the bank and the national ID database and are able to connect with each other, that's really the primary information which a bank needs from a KYC perspective. Then, if let's say, for example, this particular vendor says, I'm going to use Apple Pay. So everybody, or if he doesn't have Apple, let's say it's Android, because Android is the most ubiquitous of the phone operating systems in the world. So, you get a cheaper smartphone. You've got Android on it. So you've got the Google Pay app on it. If he's deciding to use a Google Pay app, right, instead of actually transacting with cash, that's when he starts getting to use his account a lot more. So this is something which will take time, but it will take place over time, because I think increasingly, as we see the next generation coming in, they really don't want to handle cash. I mean, I hardly keep cash with me, to be frank. And that's one of my wife's biggest gripes, that when we go somewhere, she's like, you have money? And I'm like, no, but I have this, it's my phone. So in some ways, it's a good thing. So then she gets dissuaded to buy. But, you get the point that, habits of people are changing.
I see. Okay. That's good to know. Because here in the country, there's something like 5.6 million senior citizens, and we all have to be learning, definitely. I'm learning to, pay with my debit card. I don't have a credit card, a debit card, but it's good. In fact, here also in NLEX and our expressways, we are now paying by our card also. Yeah, the RFID. Yeah, thank you.
So thank you, Vivek, for a very engaging talk, taking time of your busy schedule. Definitely this recording will be there on our YouTube digital library. This is our 48th webinar. 2 more before we enter into the Golden Jubilee. Thank you very much, Vivek. And I should also thank you, because one of my ExCom members, I have never seen, Mr. Vishal Junjunwala, I think he's your batchmate. He has served today. So I should thank you for enabling me to see my executive committee member today in flesh and blood after a long time.
I didn't realize Vishal was there. Hi, Vishal. I haven't seen him since I think he left Singapore in 2004 or 5.